Venture capital isn't for every startup, and honestly, it's not for most. If you're building a niche business or want to pass the business down to your kids, hold control, stay more profitable, VC funding might be the fastest way to lose control and crash your company. So if your plan is to build a business you can grow at your pace and live a low pressure life, venture capital is not for you. It doesn't make you any less of a great business, and that's not a failure. It's just the reality. In this video, I'm going to break down why most startups fail after raising money, the real reason VCs ghost you once growth slows, and what to do instead if you're building $1 million to even $20 million business. VCs don't back good businesses. They back moonshots because their model only works if you hit $1 billion outcome. Everything else they write off. So let's talk about the question most founders don't ask. Do you actually need VC funding? You get traction, you get some early customers, you build an MVP, and then you build a pitch deck because every TechCrunch or Forbes article inspires you to or tells you that it's time to raise. And then investors ask, how big is your market? How fast can you grow? When do you plan to exit? But what we don't realize is that taking on investors is like getting into a marriage. Shared control, difficult decisions to make, different expectations, and so much more. And because VCs don't invest in $10 million businesses. They invest in $100 million plus outcomes. And here's the part nobody tells you. A $20 million business with 20% profit margins makes $4 million a year. Even split between two founders, that's $2 million each every single year with no dilution, no investor drama, just a solid, profitable business. So you don't need VC or even to hit $20 million to be happy. You just need paying customers, focus, patience, and control. So before you spend another weekend on your pitch deck, ask yourself one question. Am I building a unicorn or am I building a business? Either answer is valid, but only one needs venture capital. So don't let the TechCrunch headline pressure you into a path that doesn't fit. The world needs more founders building great businesses, not just unicorns. Most startups fail after raising money for a few key reasons. And ironically, many of those reasons stem from raising money too soon for the wrong reasons. Here are the top causes especially relevant to your niche. So one is premature scaling. VC funding often pushes startups to grow before they've nailed product market fit. They hire fast, spend fast, and build for scale, but not for sustainability. And when the growth doesn't match projections, that burn rate is going to catch up. And chasing vanity metrics, founders feel pressure to show traction, users, download views, instead of focusing on actual revenue. These look good on a pitch deck, but often don't translate to a viable business model. And loss of focus, because raising money brings more voices into the room, board members, advisors, investors, and if you're not aligned, that vision can drift. So you start optimizing for investor expectations instead of customer needs. And a lack of discipline. Having capital in the bank can lead to bloated teams, unnecessary tools, overproduction, poor economics, and it's easy to confuse runway with validation. And no clear exit or long-term plan because many founders raise because it's what you do next, but they haven't defined what success looks like for them. So without that, they're stuck on the VC treadmill, tracing future rounds rather than building a real business. Taking on investors should be for strategic reasons only, not just because. Most don't end happily. I did another video on this, so I'll link it below, but like a marriage, divorce from an investor can be ugly, messy, expensive, and most don't end happily. So if you're considering the investor route, be sure to take it very seriously because not all money is good money.